Taxes will be one of the biggest expenses of your entire life. And while you absolutely have to pay them, most Australians are paying way more than they legally need to. So in this video, I'm going to show you 5 strategies the ATO allows you to do to reduce your tax bill and keep more of what you actually earn. Let's get straight into it. Before we talk about paying less tax, you need to understand how tax is calculated in Australia. Because a lot of people get this wrong. Australia uses what is called a progressive tax system. The more you earn, the higher rate you pay. But here is the part that trips people up. You do not pay the higher rate on all of your income. You only pay it on the portion that falls into that bracket. For the 2025-26 financial year, the tax brackets for Australian residents look like this. The first $18,200 you earn is completely tax-free. That is called the tax-free threshold. Then you pay 16% on earnings between $18,201 and $45,000. Then 30% on the portion between $45,001 and $135,000. Then 37% on earnings between $135,001 and $190,000. And 45% on anything above $190,000. On top of all that, most Australians are required to pay a 2% Medicare levy. So on a $100,000 salary, your effective tax rate, meaning the actual percentage of your total income that goes to the ATO, including the Medicare levy, works out to be around 23%, not 30%. That higher rate only applies to the top slice of your income. Now here is where it gets really interesting, and this confuses a lot of people. This is our friend Ben. He is an engineer from Brisbane, earning $130,000 a year. His boss recently offered him a $10,000 pay rise. And Ben actually thought about saying no. His exact words were, "I do not want to push myself into a higher tax bracket and end up taking home less money." Look, Ben is not alone in this thinking. I hear this all the time. In fact, I used to believe this myself when I was younger, since school never taught us how taxes work. But in this example, Ben has completely misunderstood how tax brackets work in Australia. And that misunderstanding nearly cost him a free $10,000. There's a cool calculator on the Money Smart government website that lets you calculate your income tax based on your salary. And it's going to help us explain Ben's predicament. At $130,000, Ben is in the 30% bracket. His boss offers him a $10,000 pay rise, taking his total salary to $140,000. Now $5,000 of that raise stays in the 30% bracket, and the other $5,000 crosses into the 37% bracket. He pays 30% on the first $5,000, which is $1,500, and 37% on the next $5,000, which is $1,850. So what is the total extra tax from the $10,000 raise? Well, as you can see, it's around $3,350. Which means Ben still takes home roughly $6,650 more than before. He does not lose money, he does not go backwards. He simply pays a slightly higher rate on the small portion that crossed into the new bracket. A pay rise is always worth taking. Always. Sorry Ben, take the money mate. The rate that applies to that top slice of your income is called your marginal tax rate. Every smart tax strategy you will ever hear about is trying to reduce how much of your income sits in that top slice. Please keep that in mind as we go through the next few strategies, because it is the foundation everything else builds on. One quick note before we move on, from the 1st of July 2026, that 16% bracket drops to 15%, and from the 1st of July 2027, it's scheduled to drop again to 14%. So there is genuine tax relief coming for lower and middle income earners in the next couple of financial years. If you're watching this video and the new financial year has already started, the bracket rates and maybe even the thresholds may be slightly different. The principle is still the same, just the numbers shift. So double check on the current rates on the ATO website. Now I'll go through the 5 strategies you can implement to pay less tax in Australia. Strategy 1. Salary sacrifice into super. This is arguably the single most powerful tax strategy available to everyday Australians. And most people are barely using it. Here is how it works. Instead of receiving part of your salary as take-home pay, you ask your employer to redirect some of it directly into your superannuation before income tax is calculated. That money goes into super and gets taxed at just 15%. Compare that to what you would have paid on the same money as regular income. If you earn between $45,000 and $135,000, your marginal tax rate is 30%. Above $135,000, it jumps to 37%. And above $190,000, it's 45%. By salary sacrificing, you are moving money out of the highest taxed part of your income and into an environment where it is only taxed at 15%. That difference is real money staying in your corner. Meet Sarah. She is a nurse from Perth earning $90,000 a year. She decides to salary sacrifice $10,000 into super after a tax accountant explains how it works. Without salary sacrificing, that $10,000 gets taxed at her marginal rate of 30%. So $3,000 goes to the ATO and she takes home $7,000. With salary sacrificing, that same $10,000 lands in her super fund and gets taxed at just 15%. So only $1,500 goes to the ATO and $8,500 goes into her super. Sarah just saved $1,500 in tax every single year, just by filling in a form. And that money does not sit still once it is in her super fund. The fund will invest it across shares, property, and bonds. And those investment earnings are also taxed at a maximum of 15%. So it is not just a tax saving today, it is money growing in a low tax environment for decades. Salary sacrificing is also known as making a concessional contribution. And the concessional contribution cap for financial year 2025-26 sits at $30,000 per year. From the 1st of July 2026, that cap rises to $32,500. So if you're watching this in the new financial year, you've got a little bit more room. Please note that cap already includes your employer's compulsory super guarantee contributions, which is currently 12% of your salary. You may need to do a bit of maths yourself, but depending on what you earn, there is usually room to add more before hitting that cap. To get started, just have a chat with your HR or payroll team. In most workplaces, it is as simple as filling in a salary sacrifice form. You tell them exactly how much you want to redirect into super per pay cycle, and they handle the rest. The money goes in automatically every pay. And if you are self-employed, you can make personal contributions directly to your super fund and claim a deduction on your tax return. The only extra step is you'll need to lodge a notice of intent to claim a deduction form with your super fund before you lodge your tax return. Most super funds let you do this online through their app or website. The only trade-off with salary sacrificing is that you cannot access your money until preservation age, which is around 60. But if you're planning to invest it until that age anyway, then it's not really a trade-off. It is just investing in a much lower tax environment. Sarah was lucky enough to figure that out, and now you have 2. Strategy 2. Claim every work-related deduction you are entitled to. The ATO has a really useful page on their website called Deductions You Can Claim. I'll drop the direct link in the description. Go and bookmark it, because most Australians have no idea how many things they can legitimately claim. The golden rule is simple. If you spend money to do your job and your employer did not pay you back for it, there is a good chance you can claim it. Tools and equipment, professional development courses, industry memberships, work-related subscriptions, and then there is the big one, working from home, which has become part of the modern day working environment. If you work from home even a couple of days a week, the ATO has a fixed rate method where you can claim 70 cents for every hour you work from home. That covers your electricity, internet, and other running costs. A few days a week across a full year can add up to a meaningful deduction by July. So if your boss makes you work from home, at least the ATO is throwing you a small reward for it. The key to all of this is one simple habit. Keep records throughout the year. All your receipts, invoices, a log of your work from home hours. You do not need to submit them with your tax return, but you need to be able to show them if the ATO ever asks. And trust me, you do not want the ATO asking without anything to show. Most people are scrambling in July trying to remember what they spent 6 months ago. The ones who stay organized throughout the year consistently walk away with bigger refunds. So here is what I want you to do. Download the ATO app on your phone. I know, it sounds lame, but trust me, you'll be glad you did it during tax time. Inside the app, there is a feature called My Deductions, where you can photograph receipts and log work-related expenses as they happen throughout the year. Every time you buy something work-related, open the app and record it on the spot. It takes like 20 seconds. Then when tax time comes around, everything is sitting there waiting for you. No scrambling, no guessing, no money left on the table. One thing to keep an eye on, from 2026-27 financial year, the government is rolling out a new $1,000 instant tax deduction for work-related expenses. That means you'll be able to claim a flat $1,000 against your work-related income without needing receipts. If your actual work expenses are usually under $1,000, this could simplify your return significantly. If they're over $1,000, you can still claim the higher amount, but you will need to keep receipts just in case. So it's worth being aware of this when planning ahead. Strategy 3. Understanding the investing tax rules, especially capital gains tax. This one matters a lot if you have any investments outside of super. And many Australians are leaving real money behind simply by not knowing these rules. When you sell an investment at a profit, whether that is shares, ETFs, properties, or crypto, the profit is called a capital gain. That gain gets added to your taxable income for that year and you're taxed at your marginal rate. But here is the important part. If you hold that investment for more than 12 months before selling, you are entitled to what is called a capital gains tax discount. Currently, for financial year 25-26 and 26-27, for individuals in Australia, the discount is 50%, meaning only half of your capital gain gets counted as taxable income. The other half, the ATO completely ignores. Gone! Just like my willpower at a Bunnings sausage sizzle. Meet Jake. Jake bought some shares several months ago, and they have grown by $10,000. He is thinking about selling. The problem is he only held them for 10 months. If Jake sells today, the full $10,000 gets added to his taxable income and taxed at his marginal rate of 30%. That is $3,000 straight to the ATO. If Jake waits until he crosses the 12-month mark, only $5,000 counts as taxable income. His tax bill drops to $1,500. That is a $1,500 saving just from understanding one rule. And here is where it gets even more interesting. Jake also holds another investment that has dropped in value, sitting on a $3,000 loss. If he sells that losing investment in the same financial year as his winning shares, he can offset the $3,000 loss against his $10,000 gain before the discount even applies. His net gain drops to $7,000. Apply the 50% capital gains tax discount and only $3,500 is taxable. At 30%, that is a tax bill of just $1,050. Compare that to where Jake started. Selling at 10 months with no loss offset, $3,000 in tax. Waiting past 12 months and using this loss strategically, $1,050 in tax. Same shares, same profit, nearly $2,000 difference just from knowing the rules and being patient. This strategy is called tax loss harvesting. The key rule is the loss needs to be real. You need to have genuinely sold the underperforming investment. And you should not sell just to claim the loss and then immediately buy back the same thing. This is called a wash sale, and you're not allowed to do that. But if you have an investment you're planning to exit anyway, being thoughtful about the timing can make a meaningful difference. Now please note, waiting is not automatically the right move for everyone. Markets go up, markets go down, and whether it makes sense to hold longer will depend on your own read of the investment and your personal situation. But what matters is that Jake knows the option exists and factors it into the conversation before pressing sell. So before you sell anything, ask yourself 2 questions. How long have I held this? And do I have any losses I could use to offset this gain? Those 2 questions alone can save a lot of money over time. One important update to flag, and I can already hear some people yelling at me. From the 1st of July 2027, the 50% capital gains tax discount is being replaced. Under the new rules, capital gains will be calculated using an inflation-linked indexation method, plus a new minimum 30% tax on capital gains. The strategy of using losses to offset gains still works. The calculation just changes. Now please note, these new rules are legislated, but they don't kick in until the 1st of July 2027. There's still a chance they get adjusted, delayed, or scrapped before then, especially with the new federal election due in 2028. If anything changes, I'll make an updated video walking through the new rules and the calculations involved. So if you're watching this after the 1st of July 2027, the maths in Jake's example will look slightly different, but the principles are the same. Strategy 4. Get private health insurance, especially if you earn over the Medicare levy surcharge threshold. This one catches a lot of Australians off guard at tax time. Most Australians already pay a 2% Medicare levy. That is the standard contribution that helps fund our public health system. But if you earn above a certain amount and do not hold private hospital cover, the ATO adds an extra charge on top called the Medicare levy surcharge. For financial year 2025-26, that threshold is $101,000 for singles and $202,000 for couples and families. The thresholds are indexed each year, so they may have increased slightly if you're watching this in a later financial year. Please check the current numbers on the ATO website. If you are above these figures without holding private hospital cover, you are paying an extra 1 to 1.5% of your total income straight to the ATO every year. On a $110,000 salary, that is an extra $1,100 gone, just like that. I will drop the ATO link in the description so you can check exactly where you sit. If you're a high income earner, it's worth 2 minutes of your time to check. And here is the part that makes this an easy choice for many people. A basic private hospital cover policy will often cost less than the surcharge itself. So you end up paying less overall, you actually get health cover out of it, and you skip the public hospital wait list if you ever need surgery. That is one of the simplest wins on this entire list. A couple of things you need to know before you grab any policy. Extras only cover like dental and optical does not count. You need actual private hospital cover. And the excess on your policy needs to be $750 or less for singles, or $1,500 or less for families to qualify. Here's how to actually sort this out. Hop into any major health insurance comparison website and pop in your details. You'll see basic hospital cover policies side by side. Look for the cheapest one that meets the Medicare levy surcharge exemption requirements. Once you find a policy you like, sign up online through the insurer's website. If you earn above that threshold, do the quick maths. Compare the cost of a basic hospital policy against what the surcharge would cost you. For most people above the threshold, the answer is clear. Strategy 5. Company structure versus individual. This one is a bit more advanced, but if you run a business, do freelance work, or earn meaningful income outside of a regular salary, it is worth understanding. When you earn income as an individual, it gets taxed at your personal marginal tax rate. Depending on what you earn, that could be anywhere from 15% to 45%. When income is earned through a company structure, it gets taxed at the corporate rate instead. For small businesses with a turnover of under 50 million, that rate is 25%. For larger companies, it is 30%. Both are significantly lower than the top personal rates. Let me give you an example. There is this bloke, let's call him Brian. Brian runs a content creation business. We will call it the Brian Company. I think you may have even heard of him. Now these are not real figures, but let's say Brian earns $100,000 a year from his regular job. His business pulls in an extra $80,000 on top of that. If Brian operates as a sole trader, the extra $80,000 gets stacked on top of his salary, pushing a big chunk of it into the 37% bracket. Ouch. But if Brian operates through a company structure, the $80,000 in business income gets taxed at just 25% inside the company. That is a meaningful difference on the same money. Now the saving is not permanent. When Brian eventually pays himself from the company, either as a salary or as dividends, he will pay personal tax on that money. But here is the key advantage: timing and flexibility. Brian can choose when to take money out. In a high income year, he might leave profits inside the company. In a lower income year, he might pay himself a bit more at a lower tax rate. However, please note there are real costs involved in running a company. Accounting fees, ASIC registration, ongoing compliance. It is not the right move for everyone, but if you are generating meaningful income outside of your regular job, it is worth having a conversation with a good tax accountant about whether a company or trust structure makes sense for your situation. One other thing to flag, from the 1st of July 2028, discretionary trusts in Australia will face a new minimum 30% tax on distributions to beneficiaries. So if you're considering a trust structure specifically, that change means the tax efficiency advantage is significantly reduced from 2028 onwards. A company structure isn't affected by that change. Here's how to actually get this set up. You'll want to speak to a registered tax accountant who can review your full income, business activities, and goals. They can help you decide between sole trader, company, or trust, and handle the ASIC registration, ABN application, and ongoing compliance. Most accountants charge a one-off fee for setting up a company structure, then an annual fee for tax returns and compliance. Getting that tax advice early is one of the best investments you can make in your own financial future. Brian would agree, probably. Here are my final thoughts. Tax does not have to be complicated. Understand how your brackets work. Make the most of your super. Claim what you are entitled to. Learn the basic investing tax rules. And if you're earning well or running a business, speak to a good tax accountant and get the right structure in place. None of this needs a law degree. It just needs you to know these things exist and actually to do something about it. The ATO is not going to chase you down and remind you of the strategies you're allowed to use. That part is on you, my friend. But hopefully, after watching this, you're a little bit better equipped to keep more of what you earn. And quick disclaimer, this video is general information only and not personal tax advice. Please speak to a registered tax accountant before making any decisions based on this video. By the way, if you're enjoying this video and you made it this far, comment the words tax smart down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this amazing community of like-minded people who are all trying to level up their life. Also, make sure you're following me on Instagram and X, where I post heaps more lighthearted and sometimes funny finance content. And if you want to go a bit deeper, you can sign up to my free email newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, only cool life updates from me. And if you want to learn more ways to maximize your tax return, check out this video on screen where I'll show you how to do so. Thank you for watching. My name is Brian. This is Brian Invest, and I'll see you in the next video.